Folks, I've been around the block a few times. Born in 1930, started buying stocks when I was 11, and I've seen markets go up, down, and sideways. People often ask me, Warren, how can a regular Joe with just $1,000 start investing like you? Well, pull up a chair, grab a cherry Coke, and let's talk about it. Investing isn't about having a big pile of cash or a fancy degree from some Ivy League school. It's about thinking clearly, staying patient, and sticking to a few simple rules that have worked for me over the decades. With $1,000, you've got enough to get started, and I'm going to walk you through how to do it my way. Now, before we dive in, let me set the stage. Investing, to me, is like planting a tree. You put a little seed in the ground today, water it, give it time, and one day, you're sitting under a big oak tree with plenty of shade. But you don't get there by digging up the seed every week to check if it's growing. You need patience, a good patch of soil, and a little know-how. With $1,000, your seed's small, but the principles are the same whether you're starting with $1,000 or $1 billion. Here's how to start investing like me, step by step, with that $1,000 in your pocket. Step 1. Get your mind right. Think long-term. The first thing you gotta do is get your head in the game. Investing isn't about getting rich quick. It's not like betting on a horse race or trying to hit the jackpot at a casino. I've always said, if you aren't impressed with the picture of a company over the next 10 years, don't bother owning it for 10 minutes. That's the mindset you need, even with $1,000. When I was a kid, I bought my first stock, 3 shares of Citi's Service Preferred, at $38 a share. I was 11, and I thought I'd be a millionaire by next Tuesday. The stock went down to $27, and I was sweating bullets. Eventually, it climbed to $202, and I sold it for a profit. But here's the kicker. If I'd held on to that company, or better yet, bought into something like Coca-Cola or American Express decades ago, I'd have made a fortune. The lesson? Time is your friend in investing. The earlier you start, the better, and with $1,000, you're already ahead of the folks who never start at all. So, with your $1,000, don't expect to turn it into $10,000 by next year. Think about where you want to be in 10, 20, or 30 years. That's the Buffett way. You're not chasing hot tips or trying to time the market. You're building wealth, slow and steady, like a snowball rolling down a hill, picking up more snow as it goes. Step 2. Learn before you leap. Now, I'm not saying you need to read every book in the library, but you've got to do some homework. Investing without understanding is like driving a car blindfolded. You might get lucky, but chances are you'll crash. With $1,000, you can't afford to lose it all on a whim. So start by learning the basics. Pick up a copy of The Intelligent Investor by my old teacher, Ben Graham. That book's like the Bible for value investing. It taught me to look at stocks not as ticker symbols, but as pieces of real businesses. If you don't want to read the whole thing, at least read chapters 8 and 20. Chapter 8 talks about Mr. Market. This fella who shows up every day offering to buy or sell your stocks at different prices. Some days he's manic, offering crazy high prices. Other days he's depressed, practically giving stuff away. Your job is to ignore his mood swings and focus on the value of the business. Chapter 20 talks about the margin of safety, buying a stock for less than it's worth. So even if things go wrong, you're not wiped out. You don't need $1,000 to start learning. Go to the library, watch some YouTube videos, or read my annual letters to Berkshire Hathaway shareholders. They're free online. Spend a few weeks getting comfortable with terms like earnings per share, price-to-earnings ratio, and book value. It's not rocket science, but it takes effort. If you're willing to put in the time, you'll be miles ahead of the folks who just throw their money at the latest fad. Step 3. Stick to what you know. One of my favorite rules is to invest in your circle of competence. That means sticking to businesses you understand. I don't invest in tech startups because I don't know the first thing about coding or cloud computing. But I do know how people drink Coca-Cola, use American Express, or buy insurance from Geico. Those are businesses I can wrap my head around. With $1,000, You're not going to buy a whole company like I do at Berkshire Hathaway, but you can buy shares of companies you understand. Think about the products you use every day. Do you love your iPhone? Maybe Apple's worth a look. Can't stop eating Oreos? Check out Mondelez, the company behind them. The point is, don't invest in something just because it's trendy or because your cousin's friend says it's a sure thing. If you can't explain in a sentence why a company makes money, stay away. Let's say you're a coffee drinker and you're always at Starbucks. You notice the lines are long, the app's easy to use, and people are happy to pay $5 for a latte. That's a clue Starbucks might be a good business. Look up their financials. Most brokers let you do this for free. Are they making consistent profits? Do they have a lot of debt? Is the stock price reasonable compared to their earnings? These are the questions I ask, and you should too. Step 4. Open a brokerage account. All right, you've got the mindset, you're learning the ropes, and you've got a few companies in mind. Now it's time to put that $1,000 to work. You'll need a brokerage account to buy stocks. There are plenty of options out there: Fidelity, Charles Schwab, Robinhood, you name it. Look for one with low or no fees, because with $1,000, every dollar counts. When I started investing, you had to call a broker and pay a big commission to buy stocks. These days, you can trade for free on most platforms. Open an account, deposit your $1,000, and you're ready to roll. Some brokers even let you buy fractional shares. So if a stock like Amazon costs $3,000 a share, you can still own a piece of it with your $1,000. One word of caution: don't get suckered into day trading or options trading. That's not investing, that's gambling. I've seen too many folks lose their shirts trying to make a quick buck. Stick to buying solid companies and holding them for the long haul. Step 5. Buy quality at a fair price. Here's where the rubber meets the road. With $1,000, you're not going to diversify like a mutual fund, but you can still buy 1 or 2 great companies. My rule is to buy wonderful businesses at fair prices, not mediocre businesses at cheap prices. A wonderful business has a moat, something that keeps competitors at bay, like a strong brand, loyal customers, or exclusive technology. Take Coca-Cola, one of my favorite investments. People have been drinking Coke for over a century, and they're not stopping anytime soon. It's got a brand that's worth billions, and it sells a product that's cheap to make and hard to replace. That's a moat. When I bought Coke stock in the 1980s, it wasn't the cheapest stock around, but it was a fair price for a fantastic business. Today, Berkshire owns 400 million shares, and the dividends alone bring in hundreds of millions a year. With $1,000, look for companies with a track record of steady earnings, low debt, and a competitive edge. Check their price-to-earnings (PE) ratio to see if the stock's reasonably priced. A P/E below 20 is often a good starting point, but don't just chase numbers. Make sure the business makes sense. If you're nervous about picking individual stocks, consider an index fund like the S&P 500. I've said before that for most people, a low-cost S&P 500 fund is the best way to go. It's like owning a slice of America's biggest companies, and over time, it's hard to beat. Let's say you decide to buy $500 of an S&P 500 index fund and $500 of a company you love, like Coca-Cola or Johnson & Johnson. That's a simple portfolio to start with. Reinvest the dividends and let compounding do its magic. As Charlie Munger, my partner at Berkshire, likes to say, the big money is not in the buying or selling, but in the waiting. Step 6. Be patient and ignore the noise. Once you've bought your stocks or fund, the hardest part is doing nothing. The market's going to jump around like a jackrabbit. One day, your $1,000 might be worth $1,100. The next, it's down to $900. That's just Mr. Market doing his thing. Don't panic when prices drop, and don't get cocky when they rise. Focus on the businesses you own, not the stock prices. I've held some stocks for decades. Berkshire's owned Coca-Cola since 1988, and we're not selling anytime soon. Why? Because the business keeps chugging along, selling more drinks, raising prices a little each year, and sending us dividends. That's what you're aiming for with your $1,000. Businesses that grow over time and reward you for sticking around. Turn off the financial news and don't check your portfolio every day. The less you fiddle, the better. If you've done your homework and bought good companies, trust that they'll do well over the long run. As I like to say, our favorite holding period is forever. Step 7. Keep learning and adding. Investing's a lifelong journey. With $1,000, you're just getting started, but the habits you build now will pay off down the road. Keep reading, keep learning, and keep saving. If you can add $100 a month to your investments, that's $1,200 a year. Over 30 years, at an average return of 7%, the long-term average for the S&P 500, that could grow to over $100,000. That's the power of compounding. Your money starts working for you, and the longer it works, the harder it works. When you get a raise or a bonus, don't blow it on a new gadget. Put it into your investments. The more you feed that snowball, the bigger it gets. And as you learn more, you might spot other great companies to invest in. Just don't get greedy or stray outside your circle of competence. A few parting thoughts. Investing with $1,000 isn't about hitting a home run. It's about getting on base, staying in the game, and letting time do the heavy lifting. I've made plenty of mistakes in my life. Bought the wrong companies, sold too soon, paid too much. But the one thing that's kept me going is sticking to the basics. Buy good businesses, pay a fair price, and hold on tight. You don't need to be a genius to invest well. You need discipline, patience, and a little common sense. With $1,000, you've got a chance to start building something real. Plant that seed, water it with knowledge and patience, and one day, you'll be amazed at the tree you've grown. Now, if you'll excuse me, I've got a cherry Coke waiting and a few annual reports to read. Happy investing, and I'll see you down the road.